Hey everybody, so today I'm going to be making this video to talk about a few things on my mind today. None of this is financial advice, please do your own research. Anything I've ever said, anything I will say in this video, and anything I've continued to say is not to be construed as financial advice. I'm not an expert in any sense. I'm an idiot, everything I've said is a joke at best. I constantly get things wrong, and my views are constantly changing. And so with that being said, I want to talk about a few things on my mind. Okay, so I'll begin here with NIO as a company. So I'm very bullish on Chinese companies, and it's for a multitude of reasons. I think a lot of China bulls like myself, we kind of see that Chinese companies, when you use like a standard valuation, at least for stocks, you might look at their financial statements and think that they're a pretty good deal. When compared to a lot of stocks traded globally, especially with like Western market stocks. And for me personally, how I view investments and where to place my money, again, none of this is financial advice, okay? I'm just sharing my opinion on what I do, okay? So again, not financial advice, none of this is, okay? It's a joke at best, and I'm constantly wrong, okay? But I do get things, I actually do get things right too. I'm an early investor in Tesla. I think my average was around 20 something, $20 per share after the stock split. I invested in NIO when the company was in the dollar range. I also predicted the 2020 market crash, and I have proof of those things as well. And I also predicted the 2025 market pullback, and I predicted the 2022 market dip, and followed by a fast correction after that. So basically how I look at things is I look at how the world is, where I see the world going, and I try to see where a company I'm looking at fits into the global development. So I would like to know, like, if I see the world the way it is today, where do I see it moving forward, and how does a company that I'm interested in fit into global developments, and whether it can benefit from global developments or not. So one example is a company like NIO. When I first invested into it, I knew that despite the company being on the verge of bankruptcy, the company played a very important role in the Chinese economy. It's a high employer, it had tons of infrastructure everywhere, so if the company were to fail or go bankrupt, it would be a huge burden on the economy. And when I also looked at the Hefei government, they had a high there was like a high return on investment for companies that they would kind of acquire and then turn out and help out when they're distressed, and the company stock would do really well, and the company would do well. So another example too was with Tesla. During that time, there was a lot of controversy. The company wasn't doing so well. I think a lot of news on Bill Gates and shorts were going on around as well. But I believe in my convictions, and even if I'm wrong, which I do get things wrong, but I get more things right than wrong, and I think that's all that really matters. And even when predicting the 2020 crash or 2025 pullback, a lot of it was intuition. Like, I would gauge how things are in my real life, what available data I had, and I would kind of assume, okay, by quarter 1 or 2 2020, I think a crash is going to happen or something's going to happen, based on all the available data, whether it's like things I see on a daily basis, or the news that we see, or the data that we consume. And so anyway, when I look at a company like NIO now, sometimes I'll watch videos on where people see the stock going based on like technical analysis, or whatever kind of theories that they have, and there's a lot of truth to these things. Sometimes I agree with it, sometimes I don't, but generally a lot of them are really useful, especially if you're heavily invested in a company and you don't have the time to do a lot of research. For me personally though, I used to do a lot of research, and I would follow my companies on a daily basis. Like, when I was first investing in NIO, yeah, I'm gonna follow the company when the market cap I think was around 1 billion or something, or was it less than that? I don't remember. And the Hefei government gave them a lifeline. And yeah, I'm gonna follow these things, these trades, really religiously on a daily basis because I have so much invested into it, and there's a lot of uncertainty. But you know, after over time, as my entry, you take profits, and then your entry becomes pretty good. The fundamentals and the underlying company keeps improving, and you see this trend, and that what you invested in does well over time, and it meets your expectations, or at least, or exceeds them at even better. So I like to focus on the macro aspects of where the company is going, because there's a lot of things that are kind of guaranteed in this world, in my opinion. So if the company is playing its part, then maybe, for me personally, I don't need to know the monthly deliveries. I mean, it's sometimes I'll look at like the quarterly deliveries, or the yearly deliveries, or the financial statements, or maybe I'll kind of like get a summary of the quarterly earnings. And you know sometimes it depends on how I feel, right? If I'm, it's all really dependent on what I'm doing, if I'm making a trade or not. But anyway, with a company like NIO, I generally look at things like monthly deliveries, quarterly, and the better the company does, the better I see the Chinese economy doing, and the better I see the sector doing as a whole, then I don't really need to put as much focus on NIO as a company, even though I have a large investment into it, mainly because my average is low, and I see that the company is doing well fundamentally, and that I see the economy, geopolitically as well, and economically heading towards the right direction. So on a macro basis to a micro level, the company is heading towards a good direction. And even if NIO hit profitability tomorrow, right? If it hit profitability in some ways, I don't think that the company stock is gonna like soar like we saw during 2020. And it's not because the company is bad. It's mainly because I think, as someone who invested in both NIO and Tesla early, I think that Tesla has its own unique role as a stock. I mean, there's a lot of different views on it. Some people think that maybe it's a cult stock. Other people believe in other things. But for me personally, Tesla as a company has a big role within the global economy. Whether as a financial instrument, it allows to hold up like the welfare it helps like prop up the United States economy, like a welfare state in a sense. It helps prop up 401ks, pensions. It helps globalize trade because the company has demand for its product, which helps the global supply chain and global economy, both in East and the West, because that's where production's being done. And at the same time, the company also acts like a financial instrument for a lot of different purposes. I mean, there's just numerous things beyond the company that the stock itself does for the global economy that can I'm not saying it's a fair value, but I am saying that it has a purpose. And I think if you wanted to see NIO or a Chinese company become that, then you would have to have, like, BYD might be one of those things, but maybe NIO during 2020, that's what maybe investors were thinking was going to happen. I know I was, but you would have to see the company become a global powerhouse, as in like institutions globally would want to invest in the company. The purpose and the leverage that it has in the global economy would have to be strong as well. Like, if Tesla fails, then the global economy takes a large hit because, well, numerous supply chains lose their jobs. Numerous supply chains lose their orders on batteries, raw materials, commodities, energy demand. People get displaced from all aspects of the value ladder because if Tesla goes bankrupt. So it's not, so that's more the real economy. But when it comes to like the financial, the Tesla stock being a financial instrument, it does prop up 401ks. If it lost half its value tomorrow, then a lot of our larger indices would probably lose tons of value. A lot of firms and pensions and derivatives would be punished heavily as well. So the company and the stock have a lot of value. It's very financialized, and it's very valuable to the real economy. So yeah, that's when you see like multiples become kind of crazy. So I think when you see NIO hit that sort of capability, that's when you'll see the company start being traded at very generous multiples. But at the same time, you can do other things too, right? Like, we'll start here. If for example the United States opens up their economy more and they lower tariffs to reduce inflation, so it gives room for the Federal Reserve to cut interest rates and roll off mortgage-backed securities, then what that does is it allows for Chinese firms like NIO to export joint ventures, deflations, partnerships, and their vehicles, and receive US dollars in return. The company has also a domestic demand, which is coming near to profitability. So at the same time, a stronger yuan versus a weakening dollar and global and a strengthening yuan, right? Xi Jinping wants to strengthen the yuan. That could allow for China to use the yuan to buy, like NIO, to have a stronger balance sheet, both in USD and yuan, and they can buy commodities and raw materials for the company's inputs more efficiently. So if they want to buy raw materials and commodities domestically in China, or in regional areas, or in the Western countries, they can use the dollar, which they will receive after they sell NIO vehicles in Western markets. They can use a stronger yuan on their balance sheets to buy maybe bonds or debt, or acquire different companies or different assets or different inputs at a very competitive price from the strengthening Chinese yuan. So this makes the profit margins in the long run look very good for the company. Not only that, but it also it makes their balance sheet look stronger, and also I would assume it makes their maybe their profit margin for future profit margins look more attractive as well. So the United States, sorry, let me just get to the next one. So yeah, I generally look at these things only, just whatever's on investor relations, because I feel like I have a decent understanding of the company. Same thing with a company like NIO Technologies. It's a electric e-bike manufacturer. Like I'll think things like, well, if energy prices go down in China and raw materials go down in value as global growth emerges and emerging markets fuel up during a lower interest rate environment, if the Federal Reserve in the United States cuts interest rates and global growth grows and demand side from the United States grows as tariffs get reduced because they want to have import Chinese deflation so they can cut interest rates and land a trade deal of some sort, then maybe if the factory is running at, like, I don't know, 70 to 80%, maybe it's more efficient if it ran at 100% or 95%. It'll help like their bottom line. That's just an example of things I'll think about. So I don't really need to look at everything. I just kind of focus on the macro, especially. But maybe that's because I generally invest in certain industries that I feel comfortable with. So, you know, if I see a general trend, like this company, just like NIO, is profitable or near profitable, only relying on domestic markets. And yes, there is subsidy. There is there is government subsidies to help boost demand, but I think the Chinese economy is currently in a position where they're trying to increase domestic demand. So there's currently a lot of savings in China right now. There's a lot of deflationary spiral, to some, not exactly that, but there's some characteristics of that. So despite the Chinese, a lot of these Chinese firms that wanted to go global, so or they do have global markets, um, despite being having to face trade barriers and difficulties with a stronger dollar, um, despite all that, these companies are becoming profitable or near profitable. So when tariffs become lower, when the Western markets open up more, when global growth goes up and emerging markets go up, and you have the United States reduce their interest rates, and maybe you see capital flow from the United States into the emerging markets and China, then you have like this whole recipe of when Chinese companies can really benefit. And there's much more than that. So yeah, so you're here, Xi Jinping. When it comes to the Chinese yuan or RMB becoming a global reserve currency, I don't think that's going to happen anytime soon. I think this is something that's going to gradually happen in increments, right? So everything in this world takes time. 5, 10 years, 20 years is not that long, in the grand scheme of things. Business cycles generally take, I think it's like 1, 5, 10 years. So when it comes to things like that, what feels long to us may not be long when you're making like business plans or government plans. So yeah, as you can see here, this is the Chinese population density map. Most people live near Beijing and the coastal areas, and you have some people in the middle. Chinese companies are generally trading at a lower PE ratio, currently at 16.38 based on the MSCI PE ratio by country. So that means that China, which wants to develop deeper financial markets, which wants to move away from the real estate bubble into more productive assets like stocks, where companies can find financing through those means rather than like seeking government assistance or other means like that, you'll see that there's a lot of room for these Chinese companies to grow in PE ratio. And a lot of the companies aren't even benefiting from rising stock prices either. I mean, not rising stock prices, but the rising indices. So like even if the Hang Seng is doing well and has done really well in this past year or two, or even the Kospi or even the Nikkei, these markets, or even in the United States market, right, like the S&P 500, they're being propped up by a few winners, and because there's so much uncertainty right now, and eventually over time, as rates lower and borrowing costs become cheaper, then there's less risk, so people become more risk averse, and then you'll see capital probably flow into more risk on assets that aren't profitable yet, smaller cap, less cash, more uncertainty, like maybe NIO or NIO, or even in America, right? We have companies like that too, where there's small cap, medium caps, where capital will flow after the large caps become more seasoned. And it looks like we're having that new seasoned going on right now. So yeah, so when you look at the GDP of China in different provinces, yeah, you can see that the GDP in the coastal areas where they've modernized heavily, where they're tier 1 cities, and they have very competitive high exports in like semiconductors, batteries, electric vehicles, technology, research and development, pharmaceuticals, all these things. Yeah, their GDP is much higher in these provinces, but when you start looking at these other areas, the GDP is much lower. And so there is opportunity for a lot of wealth inequality. So I think I read somewhere that China's stock market is, the volume of transactions is like 40 to 60% retail investors. I'm not too certain, but what that means is that when you move away from housing into more productive assets like stocks or bonds, it does allow for more financialization, which is what China should do. A lot of countries, while they do benefit from overcapacity from China or more production, some countries don't, and everybody wants to grow in the pie. So if global demand grows under a situation where China has excess capacity or they produce so much stuff, yeah, it benefits the world, especially when it comes to like healthcare, pharmaceuticals, electric vehicles, green economy, and infrastructure, right? It benefits people as a whole. But then you have countries that have to deal with things like job displacement, uncompetitive exports, and it makes social problems occur along with economic problems, like especially when you're debt driven, when you have to prop up your assets. You have to manage things. And so what I think is going to happen over time, and this has already been happening, whether tariffs were occurring or not, you had China trying to develop their coastal regions along with like their places where there's more rural areas and poverty, and you want to balance, like, yeah, I'm pretty sure most of the population is within the higher GDP areas and it's more urbanization. But at the same time, you want to make sure that there isn't too much wealth inequality. So you have to do a balancing act between making sure that the country moves towards financialization, but at the same time, you need to move up the value ladder to make sure that you're competing in high export goods, which is something that the coastal regions that can take on, but you also need to balance things through developing your financial markets, like your pensions, your 401ks, your government earnings, dividends, and other things like that, so that other provinces can realize more of the gains by state-owned enterprises and private businesses as well. So these things take time. Tariffs can speed it up, and also I think it's very politically unpopular to tell businesses, entrepreneurs, and individuals that, hey, we need to change things economically and socially as fast as we possibly can, so that less people starve in other areas where there is a lack of global growth and high and not enough borrowing. So you can, if the United States paints itself as a bad thing, and we in the United States we paint China as a bad thing, we generally do these things to offset a lot of the domestic tensions and anxieties and stress, and we can direct it to like a foreign boogeyman. So these things can be good if done right. And I've seen so far in the recent news that a lot of the negative stigma that we had towards China has gone down drastically, especially since 2016, 19, 20, and 2021. So yeah, I see that maybe we're gearing towards the United States lowering interest rates, more global growth, more lower borrowing costs, importing deflation from China, more capital flows into Asia, a stronger yuan over time, a weakening dollar, but more job creation through things like service-based financialization, and maybe we can bring more manufacturing jobs from China through things like joint ventures. So I think Xi Jinping has something like like the Chinese government has like their own dual mandate kind of thing going on, where it's like dual circulation, where internal circulation would be like what was it? I forgot what it was called. Okay, I think it's like something like increasing domestic demand, because China has a lot of exports, but they need to increase the demand in order to decrease deflation. You can do it by deflating goods, which is, as I explained earlier, it's good, but you can also increase domestic demand by increasing wages. And increasing wages also helps in a lot of ways because it can increase the company's profit margins as well, which would be reflecting your stock market values. And at the same time, you also want to make sure that your export markets are very competitive, right? Because you don't want the same thing that happens in Japan, the Plaza Accord, where like the yen, where the dollar was devalued heavily and the yen strengthened way too much so that exports became uncompetitive. Like you don't want to be in that position. And China is it has nuclear capabilities, so like they can't be pressured into doing things that they don't want to do. They're not a vassal state of the United States either, so they have these things. So China can maintain their manufacturing dominance while financializing. And I think that when it comes to trade wars or anything like that, China has way more strength when it comes to these types of things. So I think that China will probably want to pressure, and the United States will probably want to do it itself, honestly, to again lower rates, roll off mortgage-backed securities so that the Fed can have more ammo to handle lower rates, and then all the volatility that comes with that as we transition to that. And China can bring a lot of its jobs to the United States as it financializes more and make more joint ventures as well, and shared business collaborations, so that we can provide the United States more jobs. I mean, you can have a NIO factory in the United States and still have and have that to access Western markets like in Latin America, Canada, and the United States, and maybe parts of Europe, but probably just like the Western region. And yeah, you can receive USD for that, and that'll allow for the companies that like NIO, for example, to benefit by having an appreciating stock market. And maybe over time, companies like BYD or NIO or Cattle or even Alibaba will play these roles similar to Tesla and Palantir and Nvidia, where they're not just important as companies and that are strategic companies as well in the global economy, but they're also very important as a financial instrument. And to me, NIO is actually that in a very small scale. I mean, I think the company employs anywhere from like 80 to over 100,000 employees. The infrastructure is built out heavily, so it's a large employer that manages the grid, that brings a lot of research and development and technology and different value types of jobs that are essential. Not only as a company, but the demand that it has for raw materials, commodities, supplies, and all these other things. So the company itself is probably worth way more for the global economy and what it produces in like global GDP. So that may not be reflecting the stock price today, but I think it will be when the financial conditions in the global markets allow it to be. And these things happen over time, right? So like modernizing the middle of China and moving your supply chains and your different types of manufacturing and production from like tier 1 to tier 2 to tier 3, like different parts of the value ladder being spread out to eventually make more efficient profit margins for different parts of the production ladder. These things take time, right? Like if you're gonna build a factory in Sichuan or something, or Gansu, or not Gansu, but yeah, Sichuan or Hubei, but you're bringing it from like Jiangsu or Beijing or Shanghai. Like this doesn't happen overnight. This, maybe it takes years, maybe it takes months, but all of these on a global scale takes long periods of time. But maybe during 2020 we saw glimpses of how the global markets are pricing in those types of conditions based on like that's where the story was heading, though I could be entirely wrong. But yeah, when you look at the global map here, I mean, when interest rates are high, the United States can buy global assets for cheap. Ports, stocks, bonds, debt distress, all these types of things, buildings, infrastructures, ports, canals, it can buy for cheap, and then eventually, as a lower rates, it can still benefit from other assets appreciating that it bought globally. It can also appreciate from global growth rising as well. So maybe that their ports and canals and their debt that they bought distressed in like Latin America or Africa or different parts of Asia will appreciate in value when borrowing costs become cheaper, and all these assets do much better in a global economy where there's just more global growth. So looking at the PE ratio of the Hang Seng, it could look like it kind of looks like here we have some sort of bottoming around this area in 2022. And yeah, I know in this area, I think this is generally where we saw a lot of the United States tech companies crash as well. And while there was a recovery, Chinese stocks didn't follow, and it could be due to numerous reasons as to why, but I don't really want to get into in this video. Let's see. So the U.S. 10-year Treasury generally mortgage rates generally follow the 10-year, and so if you want to have home prices stable, but you want to, based on like Kevin Warsh, the new Fed chair, if you want to have stable prices but not have the Fed control prices of real estate too much, what you can do is have the 10-year dictate a little bit more on mortgage interest rates. So I'm assuming that home prices and the stock market in general in the United States and globally will generally trend upwards, but rather than the United States buy too much mortgage-backed securities, they can free up room to buy more treasuries. And this can allow for more treasury demand of the 10-year as more capital flows out from the United States into China and the emerging markets, especially if China wants more, they want more global capital inflows, because it can help them refinance their debts. It can help them manage their debts as well, like in real estate, the private sector as well, and it can help for their global growth as well to develop their parts of their country at a faster rate. And let's see, the 10-year Chinese government bonds seem to have stabilized around here. So, this can be for a lot of reasons. Like as we've read earlier, Xi Jinping wants to strengthen the role of the yuan, and again, it's not gonna be like, I don't think it's gonna be the next global currency. The United States dollar has a large role to play within the global economy for settlement. So I think that there's still a lot of value in the United States dollar playing the role that it does, and eventually over time, as the world becomes more prosperous, then the role of the dollar will decrease as well. But most countries, I'm assuming, will make reformations to handle that. So yeah, it could have been, there could be numerous reasons as to why we bottomed around here and recovered drastically. Different policies from the government of China that want to back like a stronger stock market. Maybe they want to move away from real estate into the stock market where it's more productive, and maybe investors globally see these movements being made too. Maybe they predict that interest rates will be lower from the United States over time, which make other areas of investments globally more attractive. So going back to companies like NIO, I think that the company, even if it reports profitability, based on like this company, for example, I think it reports like profitability to in some areas, it won't necessarily boom in stock price, which would be, I mean, I could be wrong. I mean, that'd be great if it did, but it may not. It may do well. It may be more attractive towards investors if they can keep proving these like profitability over time. But I'm thinking that the conditions have to be right, and I think we're heading there very soon, actually. Maybe by 2026, 2027, is when we're going to see the conditions economically to help these companies have much better stock prices. So it would be politically and economically as well, like a coiled spring situation. And it's the same thing I saw in 2019, 2020. It's very similar, and it's becoming more apparent so as we lower rates in the United States. And I don't think I have too much else to say for now, but I think when Trump goes to China in April, and Jerome Powell, I believe, ends his term on May 15th, and Kevin Warsh gets sworn in, I wonder, right, if Kevin Warsh is going to be the new Fed chair. Scott Bessent is the chair of the Treasury, I believe. So, and both of them worked with Druckenmiller and George Soros, I believe. So, it's kind of interesting that you have the Treasury and the Federal Reserve pretty much work hand in hand, more closer than ever, and it's very apparent, unlike before. There was this idea that the Fed was independent. I mean, I never really thought so, but some people do, and there's always a narrative and a story that's presented, but there's probably much more complexities going on that really that are more honest as why things move the way they do in the financial markets. So when you have Scott Bessent and the Fed chair be so closely associated with each other, it does allow for more efficiency. It allows for more teamwork, I guess, when it comes to handling these changes. But I think that what we will see is you could either see the stock market do very bad in the United States or perform very poorly. I mean, it's already been performing poorly when you consider the value of the dollar losing value, and the slower return on investment gains. But you can also see that if the stock market does really well and there's a cyclical rotation or sector rotation out of like AI into like commodities or emerging markets or Asia, or even like pharmaceuticals or other companies in the S&P 500 or the New York Stock Exchange or NASDAQ that haven't been doing too well, but they are pretty good companies that are essential for the real economy, like medium cap, small cap companies, then maybe we could see a situation where maybe when that happens, it may make the indices look kind of lackluster in performance, but the real economy becomes a little bit more revitalized. Not only that, but when you have lower interest rates, maybe that could allow for the stock market to rise as well, but at a more managed level and a more managed way. And if you have support from the Treasury and the Federal Reserve working together to help move asset prices up, then you could have a situation where the wealth effect is created by a little bit less from the housing market, but still there. The stock market does well in more areas, and the real economy benefits from that, while also having deflation from China, along with more jobs from China coming over to the United States, along with other areas like Japan or Korea bringing their companies over. So some people think that the United States is moving more isolationist and that we're under like extreme competitions, but I don't really see that, because I keep seeing Trump and the United States wanting foreign direct investments, but foreign direct investments can come in numerous forms, and you want productive foreign direct investments, not toxic ones. So with that being said, I hope you have a good day. None of this is financial advice. Please do your own research. I think things are actually in a situation where they're getting better. So